Hello, everyone. We are just going to be getting started here in just a few seconds. So, thank you so much for being a moment or two early today. And we will get into it. We'll just give a few more seconds for everybody to hop in. So, hopefully, you can see us and hear me. Um, Thank you so much for making the choice to invest in yourself and your practice by joining today's CE accredited financial planning session. Today is all about learning easy to execute strategies so that you can wrap data driven, personalized insurance recommendations into your financial planning with complete transparency. A reminder that if you claim the CE credit for the May 7th session that was held exclusively for current SNAP users, you will not be eligible to claim credit for this session as we are covering the same insurance content. My name is Alex Mercer, and I will be your host today. I'm joined by my colleague, Steve Arnott, SNAP's financial planning project lead, who will provide today's demonstration and run the Q&A.
Hi, everyone.
I'd like to do a quick tech check to make sure you can all hear me and see my screen. Can you send me a quick yes or even a smiley face through your Q&A tab? This is exactly how you'll send any questions you have throughout the session. I'll be using the chat tab. Any messages you send that way are public to everyone. For private messaging, please use the Q&A tab. Do we have some of those
Perfect.
responses coming in, Steve?
Yeah, thanks, Kendall, Richard, Arthur. Lots coming in already, so great to know.
Fantastic. Thank you. Okay, so Steve, let's have our cameras turned on just to say hello. We will now shut them off to give you a full screen view of our presentation. So some of you here today are already using SNAP projections for your financial planning needs. For those of you who aren't already familiar with SNAP, SNAP is a Canadian financial planning software platform. We help great financial advisors grow their assets under management and receive more referrals through effective financial planning. If you want to hear from other advisors who are already using SNAP, you can find reviews numerous places online. For example, on Capterra, which is an independent third party software review site, you will find advisors saying things like none of their clients retire without a SNAP projection and that the software has become foundational to their firm. As you can see, we are currently sitting at 4.9 out of 5 stars. We have been in market serving thousands of financial advisors, planners, and investment managers for 10 years. We help advisors grow their assets under management and increase quality referrals. And you can see just a few of our trusted partners here on the screen. We are thrilled to share that Snap Projections financial planning software is now fully available in French. We are also now providing customer support and product demos with a French language team member. As we move into the case study, we're going to be building out multiple scenarios that we can compare and optimize. During the webinar, we'll create several projections that show how to easily model existing or proposed life, disability, and critical illness insurance policies into your projections. We'll also conduct highly personalized insurance needs analyses that will help us to determine if sufficient insurance coverage is in place. What you're seeing on screen here is an example of the critical illness needs analysis report. The arrows are highlighting the custom expenses we were able to build into the analysis based on the conversation we had with our client. Steve is going to show you exactly how to do that here today. In addition to your transparent and clear needs analysis reports, you will also have access to visual charts that show how insurance needs change over time. In this case, we're looking at the chart for a life insurance needs analysis that has been done for a couple. You can see the gap between total life insurance required and total resources available. Because we have conducted a highly personalized life insurance needs analysis for this client, John, and his wife, we can provide a transparent, data driven recommendation, which we've included in the customizable comments section of the report builder. Before we get into the case study and show you exactly how to create what you've just seen, I want to make something clear. This is a more advanced webinar than what we typically try to cram into 1 hour. And yes, I realize I said this exact same thing to you, to those of you who were here in March for our tax planning webinar. We are going to be hosting another tax planning webinar in June so we can cover more how to be more proactive with your tax planning strategies and optimizations. But we're here again today with a more advanced session. It's important to know that with Snap, we can be quick and simple, or we can conduct comprehensive planning. You can sit down with a client or prospect, enter a few data points, and create basic projections that are highly valuable within 5 minutes. We have plenty of previously recorded sessions on our YouTube page for anyone who would like to see something more basic. Just let me know. Today, we are not going to be keeping it simple. So let's get to it. Our case study today is focusing on a 40-year-old couple with 2 children. Do they have enough coverage in place to ensure they are protected? And what would happen if one spouse was off work due to a disability without disability insurance? I'll get Steve to take over now and log into Snap.
Terrific. Thanks, Alex. And thanks again, everyone, for joining us today. Snap Projections is a web-based platform, so you can access your account from any Chrome browser on any computer without the need for a download. You'll go to snapprojections.com, and then in the top right corner, you'll have the option to click Login to enter your username, password, and optional multi-factor authentication. I've entered that during today's session, so I'll go directly into the software where I can view any of the previous projections I've created, or I can get started on a new client file. As Alex mentioned, we're going to be creating a couple of projections today for a client of ours, a young family, a couple with 2 young kids. So I'll get started by entering in their personal information. We have James Chen, born 1985, and his partner. So we'll add spouse, Monica Chen, born 1986. And you'll see in the top left corner of the software that there are 3 main sections to the tool. The first step is to enter in all of our scenario setup data. So this is things like the client data, general plan settings, expenses, incomes. Once we're done with all of the scenario setup pages, we'll then proceed to the planning pages where all of that information comes together to show us our clients' lives on one page. From here, we can review information, edit values for any year or for any period of the plan. And then once we're comfortable with everything, we're ready to proceed to the client report, where we can select the charts, tables, and commentary to include in a final client-facing document. For now, we'll continue on with the scenario setup. I'll click Next at the bottom, and we'll continue entering in the plan data. So we're going to start the plan as of this year, 2025, with a target retirement age of 60 for James and 59 for Monica, and we'll run the projection until age 199. We've imported the most recent FP Canada guideline assumptions for inflation rates and rates of return on investments. And then we reduced the gross return assumptions by expected management fees to arrive at a net return assumption. All of these settings are customizable, and then you can save your defaults for all future plans. On the expenses page, we do have quite a bit of flexibility in terms of how you set up the expenses in Snap. You can actually leave this page entirely blank and wait until you get to the planning pages to have Snap help you to calculate the expenses based off of the client's current available cash flow, or by calculating a sustainable spending that would allow the client to avoid running out of money in their projection. If you do have target budget information available. We can enter that here. So we have 105,000 annual spending goal once the client retires. And then we can enter in additional expenses for itemized or one-off transactions. So they're looking for some additional travel of $15,000 a year. We're going to index that at the general inflation rate for the plan, and we'll run that from age 60 until 74. We'll highlight that in the report so that in any of the charts, it'll be itemized in the legend and we'll have it color-coded for our discussion purposes. They're also looking to do a lump sum gift to their children shortly after they retire for $60,000 total with no indexation, and they'll do that at age 60 for a single year. I'll click next to go to the incomes page. You'll see in the top left corner, we have the ability to toggle between our two clients. So I'll start with James's salary of 120,000. I'll assume that that indexes with the general inflation rate in the plan for cost of living adjustments. We're entering that as employment income, so Snap will automatically deduct CPP and EI. It will tax it, track the RSP room, and then run that until the end of the year prior to the target retirement. We can prorate this income if we want. So this is coming back to Alex's theme of simple versus comprehensive. You can create a quick and simple projection, assuming that they conservatively start their retirement January 1st, or we can enter in the exact date that they're expected to retire, and Snap will prorate the expected income for that final year. We could enter in other income such as rental properties or inheritances in future years. We can add defined benefit pension plans with and without bridge benefits. And then once I'm done for James, I'll click on Monica and we'll do the same thing there. So for employment income, she's currently earning 180,000 a year with cost of living adjustments expected. Similarly, entering as employment, taxable, RSP eligible, and until the end of the year prior to her retirement. We'll go back to James and then we'll click next to go to the assets page. You'll see that Snap adds a default non-registered to all projections, and this serves as a place to allocate future cash flow if the client doesn't already have financial assets added in the plan. In this case, we'll remove the default account and enter in some existing non-reg TFSA and RSP assets. So they have a joint non-reg with a value of 80,000 and a cost base of 70,000. And that's currently invested as 30% fixed income, 70% equity. And you'll see that Snap automatically pre-populates my rate of return assumption for each asset class based off of the general plan settings that we created earlier. But I do still have the flexibility to customize those return assumptions on an account by account basis if needed. I'll also enter in their TFSA with a current balance of 130,000. And that's currently 100% equity. And then they have an RSP with $90,000 currently invested as 20% fixed income, 80% equity. And across the top of the table of accounts, you'll see that there are tabs for each of the registered account types. So if I click on TFSA, you'll see that I can customize the assumed contribution room for the first year. This is another example where you can move from simple to customizable. We get started with a base conservative assumption of just a single year's room. And then if they had additional carry forward, you can come into these subpages and set the settings as needed. For the RSP RIF, I'm going to enter in their most recent notice of assessment room value, which is $50,000. So that's everything that I need to do for James's financial assets. So I'll go now to Monica. I'll remove the default non-reg. You can see the joint non-reg gets added automatically to her page. And then I'll just add in the TFSA and her RSP. And she's been maxing out both the TFSA and RSP each year, so she just has this current year's room available. So we'll leave both of the calculated values as they are. Going back to the assets section, I'll scroll down to the real assets and enter in their home, which has a current value of 750,000, cost base of 600,000, and that's a joint asset. And then they also have a cottage with a value of 500,000 and original cost base of 200,000. And we can set in the capital gain tax column that that is applicable to the cottage. So if they sell it or as part of their final estate, those taxes would be calculated. We can also model the future sale age or purchase age of a property if we wanted to save up for a first home, model an investment property, downsize or upsize in a future year. We can enter in those transactions here. I'll enter in their existing mortgages. So they have their home mortgage with a balance of 350,000, interest rate of 5%, and monthly payments of $2,200. And we can link that to the home so that if we sell the home at any time in the plan, if the mortgage is still outstanding, Snap will repay it using the proceeds automatically. And then we have the cottage mortgage with 150,000 balance and $1,000 monthly payments. Clicking next, we'll go to the government benefits page. You'll see that I can identify which client's page I'm currently on by the bolded highlight and then the client's name here. So for Monica, we have the ability to set the start age assumption for CPP as well as the expected future benefit. And we can enter that either as a dollar value if they're already receiving CPP or if we have a Service Canada statement, or we can enter it as a percentage of maximum based off of their historical contributions. So you'll see Snap defaults the assumption to the national average value of 57%, and I can adjust that based off of the client's income history and their expected continued work years. So there's 85%, and we'll start at age 65 in our default scenario. So Snap's going to calculate the expected future CPP received in this case. Scrolling down, we have similar customizable settings for old age security. So I'll leave that with a start age of 65 and 100% of the benefit. Toggling to James, I'm going to update the start age to 65, and then we'll assume 80% for the annual maximum. I'll click next to go to the insurance page where we can add life insurance, disability insurance, or critical illness insurance. And I'll get started by adding in his term 20 policy that they recently purchased. You'll see we have the option to enter in term, whole life, or universal life policies on the personal and corporate side of the projection. I have some quick buttons to enter in the most common insurance types directly. So we're going to run a 20-year term with a death benefit for James of 750,000 and a monthly cost of $700. He does not currently have disability insurance in place, either personally or through his employer. So that's something that we're going to have a conversation with him about. But he does have an old critical illness insurance policy. So we'll enter that in here. And we'll just call that 20-year with RNC. And that started at age 30 and runs until 49. And the annual benefit is 100,000 with a $500 annual premium. Again, we can add multiple policies if applicable and any of the three categories as needed. I'll click on Monica's name and we'll enter in similar information there. So she's got a term 20 with a total death benefit of 900,000, annual cost of $600. And then she has disability insurance coverage through work. So we'll enter that in here, calling it work coverage. And so that's expected to be in place until she retires at age 58. And then in the annual benefit field, you'll see I can click edit, and that's going to give me the ability to project out those expected annual disability coverage amounts. In some cases, it might be indexed to their inflation, or sorry, indexed to their salary increases if it's a percentage of their salary. If it's a fixed annual amount, then we can enter that in here. In this case, she is at the maximum eligible amount of $8,000 a month that her employer provides. So we'll enter in 96,000 as her annual benefit, and we'll copy that down until the end of her coverage period. And then because the annual premium is being paid by her employer, we'll leave that out of this projection. But ordinarily, if it was a private policy or if she was responsible for paying that out of her own cash flow, you would enter in the annual premium here. And then Monica does not currently have a critical illness policy in place. So again, we'll do some needs analysis, see whether that might be recommended, and then discuss the coverage amount that would be ideal. Continuing with the scenario setup, I'll click on the education page and we can enter in their RESP for their 2 young kids. So they've got a family plan with 26,000. And they have 2 children. Jeremy was born 2018. They've claimed 3,000 in CESG already. The expected annual education cost is 10,000 per year with a cost inflation adjustment of 3%, start age of 18, and 4 years of assumed costs. And then they have Megan, born 2020, with 2,000 of CESG already earned and similar expected education costs. So we can enter in this information. It's an optional input in order to calculate automatic withdrawals. If you want to do everything manual related to the RESP, you can turn off these automated tools and then just enter in the base plan data. I'll click save. And then on the left, you'll see that we do have a few pages still available in the scenario setup section. We could customize settings related to things like the non-registered portfolio, their cash balances and any borrowing in the plan, income taxes, charitable donations, and then corporations. In this case, we're not going to use any of those pages for the time being. So we're ready to click planning pages and see how all of this information can come together to show us James and Monica's life on one page. Now, the planning pages can be overwhelming the first time you encounter them, but once you know what you're looking at, it's incredibly intuitive and a very powerful section of the software. On the left, we have the year and our client's age. Then we have their calculated available cash flow based off of everything that's been modeled in the plan so far. So this 160,000 of available spending is being calculated by Snap by taking their 300,000 of household employment income, subtracting off their calculated taxes and premiums of 93,000, subtracting off their RESP contributions, subtracting off their mortgage payments, and then deducting any premiums. So that leaves them with 160,000 that they can allocate for additional savings or personal spending needs. And we can make those savings allocations and any additional changes directly on each of the individual planning pages. So you'll see in the top left, we have the combined household view, and then we can also plan for each of the clients individually. So we'll go to James's page to start. And we can see there's lots of other great information on the planning page. There's taxable income calculations, CPP and EI, marginal and effective tax rates. We can see all of their individual investment accounts and how those are projected to grow over time. And then we have information about their debts, insurance, and their estate. In this case, we're going to make a couple final adjustments to the plan, and then we'll be ready to review it and see whether they're on track for their goals. The first thing we're going to do is enter in annual maximum contributions to the TFSA. So I'm going to actually enter in 15,000. And then when I click run scenario in the top right corner, you'll see that Snap is going to run that calculation through all of its algorithms, and then it's going to see whether it can contribute the full 15,000 a year. If it can, it'll leave my request intact. If it can't, it's going to adjust the contribution room based off of those future projected values. So it's got guardrails in place to prevent me from accidentally over contributing. He's also contributing 20,000 a year to the RSP. So I'll enter that, copy it down. And each time I make a change, you'll see that the run scenario turns orange, allowing me to recalculate the page and bringing the button back to a green status. So once everything's up to date, I'm ready to move on and then make similar adjustments for Monica's personal planning page. So I'll go to Monica. And then I'll scroll to the right to her investment accounts. And I can make as many changes as I want all at the same time. So 15,000 to the TFSA, again, knowing that Snap will correct it if needed, and then 25,000 to the RSP. Then I'll click run scenario, just review that to make sure everything's gone through as intended. And we can see the maxed out TFSA and 25,000 a year to the RSP. So now that we've entered in the personal planning page adjustments, we're ready to review the plan on the combined household view and see whether everything is going to come together for James and Monica's needs. So now the 160,000 spending amount that we saw earlier has been recalculated, factoring in those additional savings, leaving them with 120,000 for personal spending outside of the projection. If we continue down until retirement, we can see that that discretionary cash flow is assumed to be spent each year of the plan. And then in 2045, when the clients retire, we have our target spending goal of 105,000 a year, indexed for inflation, with additional travel, our gift to the children. And SNAP is automatically withdrawing from the financial assets in order to provide the required cash flow. So it's going to check if there are available benefits like CPP and OAS, and otherwise it's going to withdraw the required amounts in a tax efficient way from the non-reg TFSA and registered accounts. And as we continue down throughout retirement, we can review the balances. We can see that they're gradually being depleted. And in the final year, there's about 208,000 left for them at 2085. So they are on track based off of their current account balances and planned savings. We can also review this in the form of charts. So if I go to the top, click on charts, we have each of the itemized expenses. So the base annual amount going out for items outside of the projection, additional travel, our gift to the children, income taxes, debt payments, insurance premiums, and then contributions to investment accounts. We can see the cash inflow chart, so where that money is coming from each year of the plan, whether it's employment income while they're working or a combination of government benefits and financial asset withdrawals. And then we have their net worth, seeing where the balances are expected to be available over time. And all of these charts are fully customizable. So if I click on net worth or click on real assets, I can add and remove any of the items from the report. And then I can hover my mouse over top of values in order to dig in and get more information as needed. So now we're finished with the base projection and we're ready to review our plans for our discussions with James and Monica. So we have a checklist of 4 items that we want to cover. The first is to model the base assumptions to illustrate the expected outcomes if all goes according to plan. So that's what we just did in our first scenario. We've shown that if they are able to work for roughly the next 20 years, continuing to earn a reasonable salary and save at their current rates, they are on track for their target retirement. The next thing we want to do is use our needs analysis calculators to determine what insurance would be required to cover adverse life events such as an early death, a disability, or a critical illness. After that, we're going to illustrate the impact on the client's outcomes if there are insufficient coverage in place. And then finally, we're going to summarize all of the information in a digestible way for the client to take next steps. But first, we're going to calculate their insurance needs by going back into SNAP and using the needs analysis calculator at the top of the planning page. So we've got life insurance, disability insurance, and critical illness insurance calculators. We'll start with life insurance. And you'll see that automatically SNAP creates an analysis for each of the clients individually, one for James, one for Monica. You can have up to 4, so you can add additional analyses if you wanted to do different types of scenarios. One example would be you may want to consider how much insurance would be needed if one of them were to pass away, and then do another analysis if they were to both pass away simultaneously. There will be differences in assumptions in terms of how much is needed for the surviving family, whether taxes will be payable or not. So there's lots of flexibility in terms of how you enter in your assumptions for the needs analysis. In this case, we're going to be modeling the coverage of debt and income replacement until retirement. So what we're doing here is we're just looking at the event where one of them were to pass away. How much would the surviving family, the parent and 2 children, need in order to continue with their current lifestyle? So we would want to pay off all outstanding debt and then cover their income that the individual who passed away would have earned until they would have otherwise retired. And we're going to calculate this annual need all the way from today until the end of the projection. So we can enter in a specific period if you want to do 5 years of needs, 10 years, or you can click on these buttons in order to quickly populate assumptions related to the projection itself. So we want to know how much insurance do they need every year of the plan from now until the end of the projection. We're going to assume that they earn a net return on their insurance proceeds of 2.5% for the purposes of the calculation. And we have two ways that we can calculate the annual income required. So we can either replace the individual who has passed away, we can replace their income on a percentage basis. So maybe we cover 50% or 70% of what they were earning before, or we can do it on an expense coverage basis. So if we want to model out how much the surviving family needs for spending and how much the surviving spouse will earn, we can calculate the difference, and that's how much would be needed from insurance coverage. In this case, we're going to use the most common approach of income replacement, and we're going to pull in automatically their employment income from the plan. So I'll just click this button, it'll populate that value. If you do want to make assumptions that that number would change, then you can just manually type in the expected income for the for the individual who's passing away. And then we're going to assume that they would want to replace 50% of that salary for a period until retirement. So that's 20 years in this case. So we're going to cover half of their gross income for each of the next 20 years. We also want to repay the debt in full. So we have 100% repayment of debt. We're going to leave tax on estate as 0 because everything would roll over on a tax deferred basis in this case. If you were doing a different type of analysis, you could of course include tax on estate as part of the calculation. We're also going to cover 100% of the education cost from the RESP that we entered. And then we're going to cover 25,000 of final expenses for things like the funeral. And you'll see that final expenses is a customizable value. So you can change the title if you want, and you can add up to 5 different custom liabilities to really create a tailored plan for what your client might want to cover if they were to pass away. Now that we've calculated the need, we can then see how much they have available in resources to cover that need. So they both have existing term coverage in place. And then we could, if we wanted to, partially self-insure through their existing financial assets. So if they wanted to use, say, 100% of their non-reg balances or use their TFSAs towards covering the insurance need, that would be an option. In this case, the clients are assuming that they would want that money for their retirement. So we're going to leave their financial assets alone and cover those earlier identified needs through the insurance policy itself. So we're now done with the input. We can click on summary and get a annual recommended insurance coverage for each of the next 61 years. So we'll see here, James is recommended to have 1.1 million in total coverage in order to provide 20 years of 50% income replacement. Plus, he'd want to repay 500,000 of total debt, cover children's expenses and final expenses. So 1.7 million need in total. Right now he has 750,000 of life insurance existing. So he's short in the current year by about 990,000. Similar calculation for Monica, 1.7 million need for the income replacement plus debt, RESP and final expenses leaves her with a shortfall of 1.4 million. That's based off of the current year values. And what we can do at the bottom is we can click see details in order to have a projection of those values going forward. So insurance needs change every year. Sometimes they'll increase, sometimes they decrease. And so we want to have a sense of how long the insurance is needed and how much the value will vary. So here we can see the calculation for income replacement. We can see the debts being covered, the final expenses. And then here's that 990,000 figure. And then next year, that's expected to drop by about 50,000 because they've earned an additional year of income. They've paid off some more of their mortgage. And so the insurance coverage required gradually decreases until age 54, at which point it's 0. So this can help you to determine whether a term policy might be sufficient, whether they want whole life, and how much they need of the different policy types. In addition to seeing this in the chart form, in the table form, we can also click on charts in the bottom left in order to get a nice visual of how much need they have and how much resources they have. So here we have total required, total available, and this pink line is telling us how much additional insurance would be recommended. So that's identifying the coverage need for life insurance. The next step is to go back to the needs analysis and use the disability insurance to do a similar calculation. So here we're going to title this 60% income replacement. And we'll do that for each of them. We're going to, again, quickly pull in their existing employment income. And then Snap automatically pulls in the disability policy that we entered earlier for Monica. There's nothing in place for James. And then we can add in custom values for any additional income that the client would receive if they were to become disabled. And then with a quick calculation, we can show how much total coverage would be recommended, less any existing, for the required additional insurance. So 72,000 for James and 12,000 for Monica. And then next, we'll go back into needs analysis once more, click on critical illness. Here, I'm going to call this recommended coverage. And there's, again, lots of flexibility for how you want to structure your coverage needs and conversations with clients. In this case, I'm going to assume that they each would replace a full year of 70% of their salary. So essentially what this is doing is it's giving them the flexibility that if they were to have a critical illness, they could take a full year off work without needing to worry about their cash flow. Whether they're covered for disability needs or not, this would be a separate coverage amount that would allow them to do so. We're also going to assume that the spouse would take 6 months off and again, be covered fully for 70% of their gross income, just in order to help the impacted individual with getting readjusted. So full year for the impacted spouse, half a year for the other spouse. And then we can add in other one-time liabilities. So if there's medical expenses expected, we could enter 10,000 for that. We could add up to 5 custom liabilities and change the title. So we can enter in things like adjustments to the home if they needed to make a change to the stairs or whatever else might be required. So we have our additional itemized liabilities, and then we can carry in any existing coverage. So James had that 100,000 of current policy, nothing in place for Monica. And then we can once again decide whether we want to self-insure using financial assets or whether we want to leave those intact. And then we, once again, get a very familiar and clean summary of how much additional insurance would be recommended. So we have a breakdown of how that's being calculated, 147,000 for income replacement, and then their additional needs that we've entered. So those are the 3 needs analysis calculators. Going back to our list of goals for our client conversations, we've tackled 1 and 2. The next is to have a conversation about what would happen to the client if they didn't have this coverage in place. So I'm going to go back into the plan. I'm going to update the title of the current scenario that I've created. And I'm just going to call it scenario 1, 105K retirement spending with insurance needs analysis. And then I'm going to copy that scenario so that I can do an alternative case where we illustrate the impact of James having a disability that prevents him from working from age 45 until 47. And so we'll show a stoppage to his employment income. We'll show withdrawals from his investments in order to make up for that shortfall. And then we'll see what the impact would be on their retirement. So here we have age 45. I have his employment income projected out. And this is one of the great advantages of Snap is you can customize on a year-by-year basis the exact amount that you want showing in each field. So I'm going to have 3 years of 0 employment income. And then instead of being able to contribute to the TFSA, I'm going to need to withdraw 40,000 until age 47. And then I'm also going to withdraw 30,000 from the RSP. So we've entered in the withdrawals. And now we can go to the combined page to see what the impact would be on their retirement. So I'll scroll down, and now because they have less money and financial assets when they enter retirement, we can see that there's a shortfall that starts as of age 87 and 86, and a total shortfall by the end of the plan of 2.7 million. So it would have a large impact, especially when you factor in the compounding on that additional money being taken out. It would really throw off their retirement plans. Now they could, of course, make adjustments. They could cut back on travel, cut back on their annual budget. They could work longer. So they might have means to cover some of those that impact. But if they want to maintain their current goals, then additional insurance would be required. And we can compare the two scenarios using our compare scenario feature in order to help visualize the differences in the plans related to the change to their employment situation. So here we can see without insurance, or sorry, without an event, they're on track for their goals. They have 101% of what they need. Without insurance and a life event, they would be at 82% funded status. We could also compare the plans in terms of charts. So we can take a look at their net worth over time. So here we have their plans kind of are the same until age 45, and then they start to deviate because we've dipped into their financial assets. By the time of retirement, there's a difference of about $500,000, and then that just balloons from that point forward because we're not able to compound their investments as well. We're dipping into principal and then starting to borrow against the home. So we've been able to calculate their needs, show them what would happen if they don't have the enough insurance in place. And the last thing we're going to do is go back into our first scenario, and we're going to create a nice custom report to give them as a takeaway for next steps with implementing the recommended insurance coverage. So I'll go into Client Report, and then I'll go to Report Builder. And by default, I have it set up so that all of the available pages are summarized in the current view. So lots of options to include various pages depending on your client conversation. I'm going to select all of them and I'm going to delete them so they're no longer part of my current report. And you'll see on the right, I have a gallery of all of the report pages available. And so I'm going to include the cover page, a note to the reader. It's basically just a disclosure. And then I'm going to have a nice snapshot executive summary at the start of the plan. And so I'm going to have the gold summary. I'm going to have the assumption summary. I'm going to have the retirement income, their net worth statement, and then their estate summary. So I can put it anywhere that I want within the report. So that's my starting point. And then the main focus of this first conversation is related to insurance. So I'm going to scroll all the way down to the insurance section, and I'm going to bring in all of the pages related to the needs analysis that we've calculated today. I'm just dragging those over. And now that I've selected the pages that I want, I'll go to the report editor. And then I can review each of those individually. So customizable cover page with your logo and a background. You've got your customizable disclaimer and notice to the reader. We've got our nice customizable snapshots. We've done detailed presentations on this tool in the past. So lots of flexibility in terms of creating custom templates. And then we have those needs analysis calculations that we showed earlier. So 900,000 recommended for James, 1.4 million for Monica. You can add in comments below. So if you wanted to recommend specific insurance policies or provide quotes or anything else, you can embed that all within the same report. For the analysis for James, we can show that chart of how their insurance need changes over time. And then once we're done reviewing each of the pages and adding any comments, we would click Generate PDF in the top right, and then we'd share that with our client. So that's everything for today. We've been able to cover the 4 items that we wanted to with our client. We've needed to move fairly quickly just due to the amount of information that we wanted to cover. We haven't been able to highlight every feature available in Snap. There's lots of other tools that you can use. There's recommendations calculators, there's stress testing to apply historical or randomized rates of return. When you do sign up for your free trial, I would encourage you to check out the Help Center from our website, where you can access webinar recordings, articles. You can contact our support team directly by phone or email, and we'll be happy to help with one-on-one screen sharing sessions in order to get you all set up in the software. With that, I'm going to pass it back over to Alex for a few next steps, and then we'll open it up for questions.
Wonderful, Steve. Thank you so much. So we have covered a lot this hour, but we are here to address any and all questions you have in just a moment. You saw at the beginning that we do have a special offer for those of you here with us today. We are going to give a special gift to every single advisor who signs up for a free trial today. Each one of you who starts before midnight Eastern time today will receive an extended 1-hour onboarding and training session. Plus, we will set up your report branding for you, and we will help you to create and save your own personalized snapshot template, just as you saw Steve do a moment ago. The snapshot is very flexible, but it's most often used in 3 different ways. It can be used as a standalone client deliverable that essentially replaces the longer client report. It can be used as a 1 or 2 page quarterly or annual review template. And it can be used as the executive summary to the full comprehensive report. The beautiful thing about this is that once your template is created, your snapshot is automatically built from the data within your projections. No extra work is required to produce this report. As part of this special package today, the support team will work with you one-on-one to create your template so you can instantly pull a 1 or 2 page report from your projections. On our pricing page, you'll see there are 2 plans for you to choose from as an independent advisor. The advisor business plan is the plan you want if you require the corporate planning module. You can upgrade and downgrade anytime, so don't worry too much about which one you select today. The full insurance functionality and capability you saw today are fully available in both plans. If anyone would like to see the corporate module, let me know and we will try to cover that in the Q&A. So I have already dropped the link in the chat for you now, which is what you can use to create your Snap Projections account, get instant access to the software, and ensure you get to take advantage of the special onboarding and training package being offered to everyone who starts today. So please click on that link now so you have the window open on your device before the session closes out. And I am going to send this to everyone via email as well. For those of you here with us today already using Snap, thank you so much for being here with us today. A reminder that you can be earning free months of Snap when you send referrals our way. This program is win-win. The referred advisor gets 50% off their first month of Snap, and the referring advisor gets an entire free month of service when the person they sent our way becomes a paying user. If you are on annual billing, you will receive a $100 credit against your next renewal. There is no limit on how many times you can do this. We have created a new referrals page that you can access from within your Snap account that makes it easy to take advantage of the Snap referral program. Okay, so plenty of questions coming in here, Steve. So let's start with for disability and critical illness, can you choose to cover expenses rather than income replacement?
Yes. So if we go back into those for a moment, sorry, I'm just copying the plan so that we have a clean slate to use for any of the changes. So if I go back into the needs analysis, for instance, and go to critical illness, we could go back into the setup And then we could either modify these current calculations. So I could adjust what I've done here, or I could actually add two more. Maybe I want to just do expenses based analysis. And so in this case, I would leave the income replacement section as zeros. So we're not going to cover anything there. And then instead, I would just have liabilities related to, whatever they want to cover. So if it's medical expenses, if it's their mortgage, if it's some amount of spending needs, then you would just kind of itemize those out here. So maybe it's 2 years of mortgage payments. We can enter in any custom values that we want, and then you would just put that information here, and then Snap's going to calculate those needs for you. So you can either use income replacement, or you can do liabilities, or you can do a combination of the two. Similar approach for the disability insurance. You can kind of customize those as needed. Same with the life insurance. So I only showed the income replacement, but I saw there were some questions related to how to modify assumptions when someone passes. So if I go into the setup, I could instead have used expense coverage. And so in that case, it gives me the ability to enter in the surviving family's spending needs. So maybe they need 120,000 a year. And this gives you the flexibility that, okay, if they need additional childcare costs because one person has passed away, or if they have extra other expenses due to the new household situation. And then you can assume the survivor income. So if they're going to go from full-time to part-time, you could modify the amount that the survivor is going to earn. And then Snap's going to calculate the net difference between needs and resources. So lots of flexibility in terms of entering in different types of assumptions. And we're always happy from the support team to help with reviewing a particular plan and methodology that you want to use. And then we have some additional training resources and articles available as well.
Perfect. Thank you, Steve. And you did just cover this really quickly with the example there, but this is just more of a comment. And I think just to correct it, the comment is, it seems the needs analysis doesn't include income loss after the passing of a spouse.
So it depends on what assumptions you would like to include. So in our original version, we are assuming that they are going to lose all of this income. So they're going to lose 120,000 of the individual who was working, and we want to replace 50% of that. So that's our current assumption. If there's going to be a change to the surviving spouse's salary, then we could add something like an additional liability for annual top-ups. So if we want an extra 30,000 a year for the next 20 years, we could add 600,000 more insurance need based off of a custom liability of survivor income drop. So again, lots of flexibility, either using the income replacement or the expense coverage calculators.
Perfect. Thank you. And a few questions around doing an insurance only analysis. So can you just explain what the minimum amount of data you'd need to enter to create a needs analysis would be, if advisors are not looking to do a, complete projection, how they would handle this from the beginning?
Yeah, so that was one of the main focuses we had with this tool, is giving you the flexibility of having an integrated calculator that uses data from your projection, or just entering in client information. So all that you have to enter into the plan in order to get started doing the needs calculators is the date of birth, name, and province of residence. So once you've entered in this client's page, you can go directly into the planning pages and then directly into the needs analysis calculators. And all that will happen is when you're in these tools, you'll see that there's not the integration into the plan. So for instance, if I were to click on, the income here, it's not going to know that they're earning 120,000, but I can just manually type in what they're earning today. So if you've entered the data already, we want to avoid duplicate inputs and potential errors. So we give you the option to pull it in. If you don't have that data already entered, you would just manually type in values throughout the section. So all you have to enter is the client's name and date of birth.
Perfect. Thank you. Okay, I'm just looking through the questions here. How long does it take the average advisor to learn how to use the system?
Good question. The standard, or from my experience on the customer success team over the last 5 years, it's typically 4 client scenarios to kind of become a master of the software. So once you start to see the same sort of inputs and assumptions throughout the plans, you really start to become comfortable. But the initial plan input process is designed to be so intuitive that you can create your first projection in anywhere from 30 minutes to a couple of hours, depending on how complex the client case is that you're working on. So the short answer is that you can, really get started very quickly. The learning curve is quite short with Snap, and that's a main focus of our team's product development. And then in terms of getting more comfortable and being able to use it regularly and quite quickly, that generally takes about 4 client cases from my experience.
Perfect. Thank you. Next question. Is it possible to see how the insurance scenario handles estate planning in addition to retirement planning?
Yes, so let's go back into the needs analysis, and then I'll go back into setup, and then I'm going to create 2 new ones. So this would be estate needs, and in this case, we're going to, again, project that all the way out until the final year so that we can see how it changes over time. We'll, again, assume that they have 2.5. And so in this case, we're assuming that both clients are passing away, and it's the final death in this case. So what would happen with the final estate? So we may still need some income replacement, right? If you have young children that want some coverage, so maybe the surviving children would need some amount of income. So we'll actually use the expense coverage in this case. So maybe we want to provide 60,000 a year to the surviving children, and they would have no income available to them, and we would want to provide that for 10 years. So we're providing 60,000 of cash flow to the surviving children. They have nothing available, so it's going to calculate that total need, and it's going to cover it for 10 years. And then if there is any outstanding debt, we might want to cover that through the insurance, or we could set those to 0 because the assumption is that the home is going to be sold, and so that can be used to pay some of the debt. But what we would likely want is to cover any taxes payable. So here we've now brought that in. So this is taxes on the RSP, the cottage sale, and then we may want to add additional custom liabilities. So we could have additional considerations that we want to include in the final estate, maybe specific goals or other items. Once we've added in our custom liabilities, then we would decide what resources we want to include. So there would, of course, be the insurance, but now they would also have available all of their financial assets. So because there's no one left to spend that, we can set all of these values to 100% and use those as part of the available resources. And so now we would, and I'm just going to do the calculation for the one. So I'll go back to summary. And so now with Monica, for James, with the estate need, they don't have any current insurance coverage required because they have 800,000 of expected liabilities upon death, expenses for the children and tax on estate, and they have 2.6 million of projected resources. So again, you can structure this however you want. If you don't want to include the real assets as part of the pool for funding their needs, or maybe you want to leave a larger estate goal to the children or to other beneficiaries, you would basically calculate everything and then get your total recommended insurance to cover the shortfall.
Perfect. Thank you, Steve. Do we have a client portal?
We don't have a login resource available for clients at the moment. You can, of course, create the client report that we reviewed earlier. You can also share the more detailed view with your client through exporting the data into an Excel file that you can share with them. The client report opportunity is on our product team's radar. Our product manager is currently talking with clients about what that would look like ideally. So it is something that we would like to work on in the future, but it's not currently available.
Perfect. Thank you. And we've got lots more questions coming in, but we are right at time here. So we're going to have to cut it short. I will follow up with you via email, so your questions will not go unanswered. So thank you so much, everyone, for being here with us today. I hope this was a valuable use of your time. Everyone who is here live will receive an email tomorrow that will include the form to fill out to request your CE credit. Again, get started with your free trial today. You're going to get a fantastic free gift for a special onboarding and training package to ensure you hit the ground running. And enjoy the rest of your day. And I'm looking forward to continuing the conversation offline. Bye for now.